Lately, I've had quite a few people reaching out to me about buying a home. And while it's not my place to tell people what to do with their money, the following are things I would consider if I were to buy a home during a recession. Although the US government is hesitant to declare if we are in a recession or not, the following criteria still apply as a general rule of thumb. Hey everybody, welcome to the Build Young, Grow Wealthy podcast. My name is Walida Cherie, and I help millennials to manage, protect, and grow their income to one day obtain financial freedom. In today's podcast episode, I will answer the question, should you buy a home during a recession? If you want to know every time I upload, don't forget to subscribe and leave a review of this podcast episode. Without further ado, let's get into this.
A recession is like a dark cloud, coming over the economy. It affects businesses, it affects households, it changes the way that many people live their lives and make their decisions. As long as you have an economy that's going to grow, there's going to be periods when it contracts and shrinks.
More money, more problems.
A recession is normally defined by 2 consecutive quarters of negative growth, which you can also think about as 6 months of the economy shrinking.
Every recession is kind of caused by something different, whether it's financial markets or inflation or something else. There's a bunch of factors that go into determining whether we are in a recession. The National Bureau of Economic Research is a group of economists who study data and, in a very non-political way, determine whether we are, in fact, in a recession.
There are other signifiers, too.
The housing market is going to be one of the first parts of the economy to slow down because higher interest rates have a really direct effect on slowing the housing market. But other parts of the economy might take longer to react. The job market, for example, it might take longer for businesses to decide that they can't afford to hire people or that they're not going to put in new investments to grow their businesses.
Now that you know what a recession is and what generally causes a recession, let's dive in on whether you should buy a home during a recession. Number 1, check the interest rates. The current interest rate on a fixed 30-year mortgage is around 6.46%. This number may not seem like a lot, but let's consider this example for illustration purposes only. In example 1, a single-family home in Indiana cost $100,000 in 2020. An ABC bank offered financing at 2% fixed interest rates for 30 years with a 0 down payment. What will this homeowner pay? After doing the calculations with the mortgage calculator, we discovered that the monthly mortgage payment is $370. The mortgage amount plus interest over 30 years will be $133,200. Now let's take a look at our second example. The same single-family home in Indiana cost $100,000 in 2023, and ABC Bank is offering financing at 6.46% fixed interest rates for 30 years with a 0 down payment. What will this homeowner pay? The monthly mortgage payment is $629, and the mortgage amount plus interest over 30 years will be $226,440. As you can see, purchasing the same home with a higher interest rate will cost $93,240 more, so avoid buying a home with a high interest rate. Traditionally, a good mortgage interest rate is under 3%. However, if interest rates continue to climb and do not fall soon, a 6% mortgage interest rate might begin to look attractive. Be sure to talk to a financial advisor and real estate professionals to gauge the market before making a purchase. Number 2, are there any signs of inflation in the... As you can see, inflation makes our lives miserable because, like high interest rates, inflation causes us to pay more for the same things. Not only will you pay more for the home you purchase, but you will pay more to furnish the home and maintain your quality of life. The best defense against inflation besides making more money is to have a solid budget and an emergency savings fund. Otherwise, you will fall short if everything gets more expensive. A few household items that will cost more because of inflation are energy, food, gas, transportation, travel, and childcare if applicable. This also includes other areas of your life such as clothes, entertainment, education, and subscriptions. Because your overall living expenses will go up with inflation, adding a mortgage into the mix seems risky. Unless you can lock in an unbelievable deal, I would wait if I were you. If you want an objective way to see how much of a mortgage plus your household expenses you can afford, be sure to grab my workbook, How to Manage on Any Income. The link will be in the description box. Number 3, are you at risk of losing your job?
Amazon, Ford, Pepsi, and more from Amazon. These are just a few of the companies that have said they were starting big layoffs in the last year. Some job cuts are expected when the economy hits a rough patch, but this is different. Not because of the number of people being laid off, but because of who.
We're seeing a really unusual situation where white-collar workers, professionals, are being laid off in greater numbers relative to the rest of the workforce.
Here's why white-collar jobs are getting cut first, and why that's a departure from slowdowns in the past. Ever since this wave of job cuts started last year, experts have said that this downturn could spell trouble for professional workers.
This recession is going to be really bad, not only for white-collar workers, but white Patagonia vested workers.
But to understand why those cuts are happening, we have to go back even further, to the beginning of the pandemic. As the economy went into crisis mode, layoffs hit a lot of industries. But ones that are not predominantly white-collar were some of the most affected. Entertainment and leisure, and retail, which hire a lot of low-wage and frontline staff, made up most of the job cuts in the first 7 months of 2020. As the economy started to recover, some industries saw the average number of employees grow from pre-pandemic levels, while others, especially those with frontline workers, grew only a little bit or were left at a deficit. But as employers are now making job cuts amid rising interest rates, they're facing two major problems. For some, it's an excess of white-collar workers who may have been hired for special projects or company expansions during the pandemic. But elsewhere, there's an unmet demand for workers, namely in blue-collar, low-wage, and frontline jobs.
It feels like we have a structural labor shortage out there where there are 4 million fewer people, a little more than 4 million, who are in the workforce available to work than there's demand for workforce.
The Fed says the shortage has multiple causes. Some of it is due to more people going into retirement, but other factors like slowing immigration are also playing a role. Some economists also say that mindsets about work have shifted amid COVID-19 for these workers. As hiring has started to slow, ads for jobs in white-collar industries have fallen the most. But this breaks from the norm of what has happened in many other economic slowdowns. Just look at the recession in the early 1980s, where blue-collar workers made up 75% of layoffs.
It's few and far between jobs are hard to come by. How about you? You hiring?
And even more recently, in 2007, just before the start of the Great Recession, blue-collar industries like construction and manufacturing were some of the first to start losing jobs. By the end of 2008, when mass layoffs were gaining steam, industries that are not predominantly white-collar were some that had the most job cut announcements. That's excluding finance, which was in a crisis.
So the classic model we've seen over the past 30 to 40 years is that when companies see a slowdown coming, they shed workers. They figure, we can always hire them back once business picks up again. But that didn't happen after the pandemic.
Some economists say that layoffs could become more precisely targeted at underperformers as companies try to hold on to their most valuable employees.
Nowadays, there is no such thing as job security because even if a recession isn't a threat to your career, AI and robots may have you packing your boxes. It's a sad fact that some people lose their homes shortly after getting their new job. I suggest not taking this approach because if layoffs are inevitable, usually the first ones hired are the first ones fired. If you want to hear about which careers are dying out so you can better protect yourself, check out my podcast episode, 9 Dying Careers That Can Rob Your Financial Future. The link will be in the description box. Number 4, can the mortgage price be justified? Buying a home is one of the most significant financial decisions you will make. It's important to understand just because you pay a lot for a house doesn't mean that you are getting good value. Check out this clip by WCNC on 4 ways to tell if the home you're looking at is overvalued.
WCNC Charlotte's Carolyn Bruck is joining us now with the signs a home is overpriced. And we don't want to be asking where's the money, but I suspect this is going to be the first step, right?
Well, here's the thing. There are 4 signs a home is overpriced, and this is according to Realtor.com. The time on the market, this is a good indicator. So if a home sits on the market longer than others in the area, it is a sign that it might be priced too high. Right now in Charlotte, we are still a seller's market. That means there are more people looking to buy a home than homes are available. The average days that home sits on the market is 45. So keep that in mind. The second sign to look for is that the comps are less. So most properties will have comparable homes. That's what comps is short for, that have sold recently. Those prices should be in the same price range. So don't get your heart set on something and then see that the comps are a lot less, because then you'll know you're going to be paying more for that. The third sign, on and off listing. This is kind of a trick according to Realtor.com. So you got to look at the property history. So most online listings will have a property history, and it'll tell you when was this property listed and when was it sold. If you see it listed, not sold, listed, then not sold, you know that they're taking it on and off, kind of to manipulate a little bit to make it look new when the property, in fact, has been on and off the market for a while. The fourth sign is it's not selling when others in the same neighborhood are selling. So if the homes in the neighborhood are selling at a certain rate, so say like typically for that area, they're selling, 30 days. This home should be selling around that same time. So if they're not, that is a sign that that home is priced too high. So those are 4 signs a home is overpriced. We just don't want you to pay more than you should.
Now let's play with some numbers using the same illustration that we used for high interest rates. Let's see how much a mortgage would cost if the interest rates are the same, but the cost of the mortgage is different. Example 1. A single-family home in Indiana cost $100,000 in 2020, and ABC Bank offered financing at 6.46% fixed interest rates for 30 years with a 0 down payment. What will this homeowner pay? After using a mortgage calculator, we discovered that the monthly mortgage payment will be $629. The mortgage amount plus interest over 30 years will be $226,440. Example 2. The same single-family home in Indiana now costs $400,000 in 2023. And ABC Bank is offering financing at 6.46% fixed interest rates for 30 years with a 0 down payment. What will this homeowner pay? After using the mortgage calculator, we discovered that the monthly mortgage payment will be $2,518. The mortgage amount plus interest over 30 years will be $906,480. As you can see, purchasing the same home with the same interest rate but with the higher mortgage will cost $680,040 more. Buying a home isn't equal in every part of the country. Some places will be more expensive whether there is a recession or not, such as coastal states, big cities, and high tourist areas. Learning how to spot a good deal takes practice, so I recommend hiring a competent real estate professional to assist you on your journey. Make sure the person helping you isn't getting you locked into a bad deal so that they can make a commission off of you. The bottom line, things you must consider before buying a home are: am I getting the best fixed interest rate? If not, then I recommend waiting. In addition to my mortgage, can I afford to maintain other areas of my cost of living? If not, make a budget and adjust accordingly. Do I have job security? If I lost my current job, how long can I afford to maintain my current lifestyle? Am I overpaying for my home? How much was this home going for in the last few years? What are your thoughts about buying a home during a recession? Do you agree or disagree with the points I've mentioned? Be sure to leave me a comment on my LinkedIn newsletter, Let's Talk Money. I'll leave the link in the description box. That's all I have for now. Don't forget to subscribe to this podcast and leave me a review. Until next time, I will talk to you later.